Hey, ladies and gentlemen, we've got a really exciting panel now. It was almost following the money, or rather the institutional money. So I'd like to welcome our previous moderator, Mike Casey, to the stage, please. I'd also like to invite one of our co-organizers, Hans-Peter Borgh, CEO of BIL, Bank International à Luxembourg, Lucas Vogelsang, CEO and co-founder of Centrifuge, Jan Brzezek, founder at Crypto Finance, and Mathew, CEO and co-founder of Dark Forest. Over to you guys.
Okay. All right, you're going to do the cross past me thing just to line up with your photographs if you can. Okay. All right. Well, hope you're all sufficiently satiated after lunch, and you had some great conversations, and are ready to rock back into some heavy, hopefully entertaining, but really useful conversation. Why don't we just quickly go down the line and very, very briefly, because we've got a fairly big panel here, just give quick intros as to who you are and why you're here.
Hans-Peter Borgh, so CEO of BIL Swiss, based in Zurich, originally from Amsterdam. And why I'm here is really to learn. For me, this is a wonderful opportunity to connect with a world that I'm less familiar with. So I'd like to leave it there.
Perfect. Lucas.
Hi, my name is Lucas. I'm the co-founder of Centrifuge. Centrifuge brings real-world financial assets on chain. What does that mean? It means we tokenize and both bring the back office and middle office of like these typical financial products on chain, but then also like figure out how do we use all these new financial primitives that are being built in smart contracts instead of legacy systems to actually support assets like private credit, public credit, real estate, really any kind of asset. So we believe ultimately, right, like the future of the financial system is digital, and digital here meaning that it will be powered by blockchains.
Yes, yeah.
Hello, everyone. My name is Jan Brzezek. I am the founder and former CEO of Crypto Finance. We're now part of Deutsche Börse Group. We provide execution services, settlement, and custody to financial institutions, primarily banks. And asset managers, we're based in Switzerland, but we have now a BaFin-regulated subsidiary as well in Germany for the European expansion. And there are much more great things in work within the Deutsche Börse Group. Thanks.
Finally, Mathew.
Mathew Arrow. I'm the co-founder and CEO of Dark Forest. We supply liquidity to the digital asset markets, and I'm here to help unify and unite the disparate ecosystems.
Great, that's a good place to start because I think that's a unifying theme here. So the title is the ETF and tokenization era. I got thinking about like what is the through line between ETFs and tokenization, and I think where I landed was this idea that both of them seem to represent a merging of these disparate worlds, the TradFi world with the crypto world, but from two different directions, right? Like the ETFs or ETPs in Europe are a mechanism by which we can take the crypto native assets and give them a wrapper, a kind of a TradFi accessibility to bring people from that world into crypto. Tokenization comes up from the other direction. It's taking these assets that have sort of been traditionally dealt with by the traditional financial center, the financial system, whether it is, financial instruments like bonds or it's things like real estate, giving them our tokenization and allowing them to be traded on chain and given all the magic of a blockchain environment. So the conversation, I think, is going to be as much about in those two directions, how are we resolving the divide, the disparate worlds that Mathew was alluding to. And we've got, I think, a great representation, somebody from the TradFi world, others who are more steeped in crypto, and others who sort of bridge those worlds. I just want to make one little observation. I've been covering crypto for quite a while, showing my age, 12 years basically. there is nothing new under the sun, right? Tokenization, for example, was widely discussed in around 2016, 2015, when people were coming out of the first of many Bitcoin booms and crashes, and they said, well, you know what? There was this phrase that would come up called blockchain, not Bitcoin. That was the line that was often used. And a lot of banks were getting in and saying, we're going to build these permissioned private systems. And around that time, or a few years later, the World Bank issued a bond and sold it as a primary issuance only bond. And there were bonds based on, actually, I think it was Australian, David, was this the central bank was in Australia. Anyway, the point was, it was Commonwealth Bank. Anyway, these bonds were issued, but they were all settled off-chain. And it was a first little foray from the World Bank into sort of tokenization, but it really wasn't very crypto in some respects, because at the end of the day, you still had to settle everything off-chain. SDX, I think just yesterday, is that right, David? Or yesterday? David Nunes, if you want to talk to David Nunes from SDX, issued a $200 million a World Bank bond, which is now can be traded in the secondary market, and was settled on chain because it integrates CBDCs. So it's just a way to describe how things are progressing, and it's gone from this kind of like superficial blockchain, not Bitcoin, into something that is actually a much more integrated on-chain experience. So with that intro, I want to throw to you, Hans, because you were at a gathering of bankers recently, and are they getting religion, I suppose, would be the question.
Yeah, you're right. Actually, it was earlier this week on Tuesday, we had the annual highlight of the season of the year, where all the CEOs of banks in Switzerland would gather for a seminar hosted by the FINMA, who are the supervisor of banks in this country. It's about similar setting to this, about 200 of us. Difference probably being that we all were wearing less comfortable shoes and ties and so on, but otherwise very, very similar. And it was a half-day conference dedicated to the main topics of the year for the banking industry. And to my delight, actually, but also surprise to some extent, one of the 5 topics of this year's annual Swiss CEO conference was actually blockchain, and hosted by the supervisors, fintech specialists. So this shows you a couple of things. First, it wasn't about cryptocurrency anymore, per se. So in previous editions, one would have spoken about enabling our clients to invest in cryptocurrency, mostly Bitcoin and so on. But I think the industry starts to understand, the traditional industry starts to understand blockchain as a technology, but also the authorities, the regulator, and the Swiss regulator in particular, are demonstrating, let's say, their, progressive attitude by facilitating, by having blockchain as one of the top 5 topics on this annual meeting. So for me, I think whether it's a change of religion, I wouldn't say so. I think our bank, Bill, was founded in 1856. So we go back quite a while. So change is incremental and is not radical. So it's a progression. So did we overnight completely change our religion? Maybe not. But I think the industry is much more, the awareness and understanding of what blockchain can offer, or what decentralized finance, what we can learn in traditional finance from DeFi, I think is progressing. And I think you start to see a lot of small and bigger initiatives of the industry embracing that. So I think, yes, the beginning of a change of religion, I would summarize.
Right, but maybe to achieve that, adoption trend, you have to be sort of solving for real problems that exist within the TradFi world. So there's this, you can't go all in, right? In a pure crypto DeFi world with a bunch of banks, you'll need to have these hybrid solutions. And have we found the middle ground? I actually want to throw to Lucas after this, but like where we're getting all the true benefits of, on-chain settlement and everything else, but we're also sort of servicing what TradFi needs from its regulatory perspective and everything else.
I think we start to see it in pockets. Wholesale payments, various initiatives across the globe, where also banks start to embrace, still on a pilot basis often, on-chain payment solutions. Documentary credit, that's a technical term for trade finance. That's the type of credit that banks use to finance goods when you send a container of cocoa beans or other commodities that's financed against a document and a document against the delivery of that product. In that space, it's not something where we are particularly active as a bank, but you see banks are starting this. These are prime examples where blockchain is kind of a natural fit as you have to trace a flow of a document in this example. Closer to home, we are Luxembourgish based in our bank's home country in Luxembourg. A bank starts to use blockchain for student loans so not yet mainstream, not yet full-blown mortgages or everything, but we are dipping our toes bit by bit where we discover that real traditional finance problems can actually be solved better. And that's, I think, the key to more. But I think it's step by step, careful experiments, and when that all goes well, hopefully accelerate.
Okay, so Lucas, you mentioned to me last night that, I mean, there's a standard that should be met for tokenization to be valuable, and that this halfway measures, the allusion I made earlier to the Bondi bond, it's kind of pointless. Explain that, and within the context of what Hans is saying, are banks ready to go all in on full on-chain settlement and everything else?
So I think maybe one thing that I have to think about, as you started saying, you've been covering crypto for 10 years. So Centrifuge has about 7 years of history now. At 7 years ago, we did not have stable coins with any popularity. Uniswap, which is now one of the prime examples of DeFi, right? An automated marketplace for any tokens you can trade 24/7 against basically a smart contract as opposed to having to find a counterparty. There are some trading pairs that have $1,000 of liquidity, others have billions of liquidity. So you have that actually launched in 2019. So it's not overnight, I would say, but even DeFi itself is actually still relatively fresh. And so I think we did get to a point where DeFi is now real enough that yes, a person in finance can look at it and say, yeah, actually there's something to learn from it. I think that is actually extremely valuable and one of the biggest steps we've made. Where I think tokenization also wasn't new when we started in 2017. In fact, it was a big trend at the time. There were two problems in my opinion. First, we didn't have the DeFi infrastructure to actually then do something with these tokens. So a lot of times it was a two-party transaction where the reality is probably would have been easier to just send a contract via email as a PDF, right? And nothing ever happens with it after. And the other part is, I think, the settlement part, which I think if you rely on kind of your legacy financial rails to settle a transaction, a lot of the benefits of having a smart contract that is supposed to do the trade, the transaction, actually go away because you now still have all of this all these failure cases that can happen between execution and settlement that you still need to deal with that. So you don't actually benefit from that. And so I think for me, the two things we focus on is, first of all, yes, we absolutely want to settle this stuff on chain because that's when the technology is really going to help. Different countries, different financial institutions have different levels of regulation already in place or risks that they're willing to take, right? In the US, we're actually they're actually discussing the stablecoin bill right now. A global financial bank in the US, a global financial institution, will not probably start holding a significant portion of their balance sheet in USDC, which is a privately issued, or USDT, which are privately issued stablecoins, right? Because they don't, while they're probably not illegal today, as we've seen by the lack of enforcement action, still there's no kind of clear law that gives them this license, right? So that is, I think, in the US, a big step for actually making the settlement possible. I know Switzerland, Europe, MiCA, right? There's a lot of this stuff that's happening that will actually make the settlement part much easier. That I think is going to be a massive unlocker over in the near term. I think the other interesting story that I would mention on tokenization is the work that Project Guardian did. Centrifuge is not involved in that, but Aave, which is kind of an overnight, a smart contract version of an overnight repo market, where you can go and borrow ETH and lend or borrow ETH against USDC collateral, or Bitcoin against ETH, right? And you can do this without any counterparty, 24/7 with smart contracts. Collateral liquidations are enforced by code as opposed to like done manually, right? So all this stuff is actually, it's a really good example of what DeFi can do. And Project Guardian did this with a couple of banks in a kind of pilot. Well, it's still a closed pilot, but they used that code base to build a kind of a repo transaction using smart contracts. And I think those things are the kind of utility that we need to get to for tokenization, really to start making sense and deliver on the value that you asked about.
Yeah, it's the power of programmability in a way, right? So once everything is given a digital form and is a true identifiably distinct digital asset, that you can now bring the power of things like DeFi to it. So it's again interesting to see what happens to your bonds, David, now that they reside in this environment. What creative things will people build on top of that? So on that basis, Jan, I'm going to jump you because I want to get to ETFs after this, but I'm going to throw to Mathew. You're in an innovative, sort of somewhat more radical world of crypto. How do you think about this from the new financial models and opportunities that could arise out of the digitization of these assets?
Well, I think Lucas brings up a good point, primarily around settlement of assets. And we're at a point right now where we can work on advanced gene theory, artificial general intelligence, but yet we cannot liquidate a margin call or have a trade settlement on a weekend. And to me, this is rather archaic, especially that we have the efficient technology to do so right now. And we have a 21st century innovation that's currently being dictated and governed by 19th century ideologies. So I do think it's inevitable, and that the arc of history does trend towards digitization over time, and finance is no different.
All right, so be warned, everyone. Jan, so again, coming at it from the different direction, right? So ETFs now also something that in the crypto world, not a new idea. In fact, the big news of the past year is the eventual final approval of a Bitcoin ETF in the US by the SEC. But the earliest applications for those, I think, date right back to 2015, if not 2014. So it's a long journey that process went on to get here. Why is it important, right? Because I think one of the questions that a crypto native would say is like, I can own Bitcoin, I can spin up my own wallet and own it. Why do I need this intermediary in the middle? What is the value that this I suppose hybrid and insertion of the TradFi model into that crypto space bring to adoption, to everything else?
Yeah, very good question. And I think it comes a bit back to Lucas' statement before, where banks have legacy infrastructure and banking clients want exposure to Bitcoin. They don't, most of the people cannot set up a wallet themselves or don't want to own Bitcoin themselves. They rather want to have it included in a portfolio of their bank. But banks are struggling massively with custodying Bitcoin, right? Not only Bitcoin, by the way, but the whole tokenized assets. Tokenizing assets is amazing. It's going to be a long-term vision. It will change a lot. It will create millions of opportunities. But right now, banks are really struggling. So for them to fulfill a client demand, but as well being able to make a business out of it, is the Bitcoin ETFs. Because by that, they can give their clients exposure to crypto without changing the whole IT infrastructure. And that's why I think we have seen a massive, and we will continue to see a massive inflow into those ETFs. Which will enable traditional investors to get an exposure into crypto and put their first toe into the water. And with that, when the banks see, oh, there's a demand for that, they will expand it. They will then, as we have discussed before, expand the universe. Right now, keep in mind, it's just the Bitcoin ETFs. So there are thousands of other tokens. tokenized assets, which only will come over time. And then they have a reason, they see, oh, there's demand, they have a reason to change the IT infrastructure. And I would say over the next 5 to 10 years, they will then really be able to hold tokens which represent not only a crypto native token, but as well a real world asset.
So it's like a bridging mechanism as well, right? It's like, this is the starting point. You're going to have to get your custody systems lined up.
Yeah.
And when you do so, that makes it easier to take the next step to move into something like tokenized assets or other crypto assets.
You have BlackRock holding Bitcoin now, right?
Right.
Which we didn't have before. It means like it's the first step towards holding any other token. And it's not just BlackRock, it's like dozens of other, right? Yeah. Exactly. And I think like tokens in the end are tokens, whether it's Bitcoin or ETH, or a real estate or a government bond. It's not that different.
I think,
and that is a good first step. I agree.
What we have seen with the ETF approvals is it gives legitimacy to crypto, to Bitcoin. A lot of people I know who are very conservative or anti-crypto said, okay, but now Bitcoin, BlackRock, Fidelity, Franklin, and many others have launched as an ETF on that, and it has a value, and it was probably one of the most successful launches of an ETF in the past, right?
I think it is the most. I think it, by certain metrics, is the most successful ETF ever.
Depends on the metrics.
Right.
Some people always like to change it the other way around, but actually, I would say it's personally, I would have never expected that to be that successful.
Yeah, and it's a representation of investor sentiment as well. So you start with something very passive like a mutual fund. You move to something slightly more active like an ETF. You're starting to see the proliferation of active ETFs, different forms of ETFs, thematic ETFs, and the obvious next step, as Jan and Lucas said, is tokenization, where ETFs is just the first step, but the next one is tokenization of all assets, and it's a much more active role for investors, and I think this represents what the new generation of investors want.
Yeah, it's sort of seen as a progression, right? It's like, we can't just leap into this new world. We have to have these steps, but each one of them leads to another step, right? I was thinking, sorry, yeah, go on now.
Just to add on, I mean, I have seen now several family offices, ultra high net worths, or even banks saying, okay, now we have the Bitcoin ETF. What's next? Mm-hmm. Right? So once you're in there, you see, okay, there's a demand, there is really something, it has a value. So what's next? Where do we need to go in a more strategic perspective?
I think we hit mainstream when we have meme ETFs.
Your diversified portfolio of Shiba Inu and Pepe. Actually, when Lucas was talking about it's a big deal now that BlackRock actually custodies Bitcoin. I was thinking about something that Trent from Ocean Protocol was telling me in the break about how in the early days when you tried to onboard people into Bitcoin who had no idea, you just take them out to here's $5 worth, whatever, and you give them a wallet, right? It's actually the institutional equivalent of the same thing. Here, have an ETF, just like, see what you can do with it, right? Like, get yourself familiarized. So on that note, Hans, a banker's feeling more willing to experiment with this stuff, and also, like, I think, why, from your perspective, is an ETF important as opposed to just direct self-custody of Bitcoin?
Yeah, absolutely. I think the debate that we're having today is much less whether an investor should allocate part of his assets, part of his portfolio to cryptocurrency, but more how, and that's where the ETF discussion comes in. I think at the same bankers meeting that I attended earlier this week, I learned that 35 of the 230-odd Swiss banks offer some form of cryptocurrency custody solutions to their clients already. And maybe to share a very short personal anecdote. I mean, I started years ago, before the first conference in Lugano, before I met Sasha on this topic. But a friend convinced me of the decentralized concept, and I should hedge my risk and have some Bitcoin somewhere safe for when all hell would break loose. So I opened a Binance account. Now, then some rumors started to come, and so I got a bit nervous. And then another friend said, you shouldn't leave your hard-earned savings on a Binance account. You need your own cold wallet. We said, cold what? Well, yeah, okay. So I bought a stick. I guess many of you know this much better than me, but I bought a nano ledger stick. For the ones of you know what it is, it's like a little piece of plastic that goes into the USB port of your computer. and you transfer your hard-earned money on that stick, and that becomes Bitcoin. And I thought that's really safe. So I put it somewhere safe, and then you get like some passcodes that if you lose your stick, you can, with these codes, you can recover your money. So eventually I put that somewhere else in another place, all safe. Years later, I tried to see whether, sometimes I looked on the stick once in 6 months, whether there's still something on it. And the stick works with a PIN code, with an LCD crystal display, where you have to enter your PIN code to enter your Bitcoin. But the crystals started to fade. So I couldn't enter my PIN code anymore to access a significant amount of money that I hold on a piece of plastic. So I got it was on a Sunday night. It's a typical thing on Sunday evening, a boring end of the weekend is, do my Bitcoin still exist? I said, what the is going on? So I really got sleepless nights, but I thought, okay, I still have these passcodes there in another place, in another country even. Now, and it's really true, but I fast forward a little bit. I arranged the next time I would go to that other place to pick up my piece of paper, because I was also told, don't take a picture of that sheet with these words, because that's already, of course, in the centralized system. So I listened to my converted friends, and I did everything right. Then I lost the piece of paper, believe it or not, but I really did. And it was still a couple of months' salary that was on that piece of plastic, where the crystals had by now completely died. So I went to Google, and Google offered a solution. So I had to open my piece of plastic myself, order a new LCD crystal display somewhere on Alibaba or whatever, and to refix this crystal display to get this bloody stick to work again. And in the end, it all worked. And then, and that's my biggest regret, and then I stopped. This was early this year, just before the surge in crypto prices. I said, yeah, now I have to get it off my stick once the stick works again. And I didn't know how to do that because I had no other wallet, so I sold everything. So I was back into Swiss francs and euros, and I missed the whole upturn. So, and this is a real story. And for me, I kind of gave up on my attempt to do it in the right decentralized way. So if I can buy a BlackRock ETF, I think I will be very happy to do so, even though I was convinced by the argument. So for me, I'm probably a bit dumb in all these things, but it's still we're probably also not the only one. So it's still a long way to go, I think, before we're all comfortable with our sticks and gold wallets and so on. So I think we as banks have a tremendous, I think, obligation actually to our clients to help them to in some way get access to an interesting asset class that is convenient and safe. So very long answer to a simple question.
I love it. I mean, such a colorful and valuable anecdote.
I mean, at least you got the Bitcoin back. I had a lot of friends who did not.
Yeah, there's a lot of
I think that is the more normal outcome of the story.
Yeah. But it really just brings it back to a point that is also, again, in my long 12 years of covering this space, always seems to be there, and that is UX, right? The idea that, until this technology becomes accessible, and it is increasingly becoming so, let's face that. That's what's interesting about some of this movement, this merging of these two worlds, is it is getting easier. But, for so many people, using DeFi, for example, is incredibly complicated. What needs to happen from all of your perspective? Like, what do you see as the killer app almost, or the killer problem to solve that's going to allow the onboarding of not only, individuals like Hans, but also institutions to say, oh yeah, this is actually something safe, but also easy to understand and accessible?
I would say the underlying infrastructure needs to be improved greatly from where it currently is, especially once institutions start to capitulate and come into the space. It's famously known right now that even the incumbent centralized exchanges are facing existential problems when there's any spike in volatility or volume on the exchange. They simply shut down for 3 to 4 hours during the middle of the trading day and ensure their customers that the funds are safe, but yet they can't interact with it. And so, I mean, if this is the case now, and institutions have only just started coming in, then this needs to be solved before the
that's a back end thing that scalability.
The back end underlying on top of the UX as you mentioned, but if we don't have the infrastructure in place that can scale to allow for the institutions to come into place in the first, then the UX is kind of secondary.
And yet again, I'm sorry I keep using this reference, but 12 years of covering this, there's been numerous advances in terms of scalabilities, ZK roll-ups, all sorts of things to make the underlying infrastructure scalability get there. Why are we still struggling, Lucas?
I mean, I would say we're like having pretty high expectations. I think the internet is now more like 40 years old. Like if you asked anyone to order pizza online in the 90s, I don't think anyone in this room would have been able to do it. The couple of professors that have been using the internet for 5 years already in the early 90s, sure, because they had the computer at home and had access to it. I think like we're going to go through a similar kind of, we're in the first decade. I think the second, this will accelerate a lot. I think just in general, like trying to have this perspective maybe makes you realize, okay, well, it's like not as bad as it actually is, because like we have, what is it, like 25%, 30% of adult Americans have owned crypto, either indirectly or directly. Like we've made massive advances. I think we had, there's technology being built so that your web browser can actually like hold a fairly safe cryptographic key, where you simply sign up and within a minute have a wallet that at least is like tied to your phone and isn't easily hackable. There's still the problem if you lose your phone, of course, that can be an issue. But I do think there's like several places here where like we are making a lot of progress. I think specifically around tokenization and TradFi institutions coming in, I do think a big problem today that we still have is that mostly I think because of a lack of regulation, we have huge friction going in and out of crypto, and that makes it expensive. Like when you are financing a trade finance deal that is yielding, let's say 7% a year, but you have 20 basis points of transaction fees because like 10 bips, you sell your USDC and you turn it into dollars and 10 bips going out, right? Now, relative to your 7%, like it's going to be a pretty hefty fee. Like you don't want to do that, right? Now that is actually putting crypto at a disadvantage over a traditional financial product. And that's kind of like the work that has to be done there, where I think like regulation better, like banks having lower associated costs with dealing in crypto transactions because compliance is figured out better. Stable coins are like maybe not a risk that they have to do, but it's simply something they can hold on their balance sheet the same way they can hold cash, right? I think those kind of things will increase the maybe not the usability, but like the cost in some of these things, which ultimately will make a lot of these cases more viable.
It's a really good point. I'd like to hear, Jan, your take on this actually, and maybe also Hans, because hear sometimes from say the more crypto savvy and digital asset friendly bankers who just say, like in some regulatory regimes, and I believe it's the case in the US, the old custody rules still have to be in place alongside this new sort of custody mechanism that needs to be created. Like you're just duplicating the cost, compliance, all that sort of stuff. And to Lucas's point, it adds cost and friction and therefore sucks away the actual benefit. I don't know if it's the case here or elsewhere, if it's become more unified. I mean, how are we resolving almost like it's really a regulatory challenge more than anything else, right?
Yeah, so first and foremost, I can confirm Hans Petter's impression. Every time I use my hardware wallet, I get wet hands if I do everything right. But no, the other point is definitely we need to have more patience. Rome hasn't been built overnight. It's coming. I think we do a tremendous progress, but I don't think everyone needs to be able to access blockchains really themselves. There's so many use cases where it just doesn't make sense, where you want to have it aggregated, you want to have it done and provided by a financial institution out of several reasons. So we have a legacy infrastructure and we need to apply regulations which are coming in place now. Switzerland has it for quite some time. Europe is coming by the end of the year. The US is still working on it. So it takes time, and then we can build. What is done currently, what I see is the banks are trying to integrate that into their existing solutions, and more the fintechs are going the greenfield approach. Greenfield normally is much faster to build compared to the other ones. And when you talk about custody and the regulations which comes with it, keep in mind that a BNY Mellon, who is like 150 years old or even older, they have their legacy infrastructure, and that they can offer that to their clients, even though they have massive hurdles. So it's just a matter of time, and maybe it's even better for them just to go a greenfield approach as well and collaborate with existing providers. But the fintechs are there, and now it just needs another 5 to 10 years until we see a merge. Either it's going to be built on, or it's going to be moved on the legacy infrastructure, or the legacy the incumbents are using then a greenfield approach, which I can't really have an opinion. I don't really have an opinion yet how that will be happening.
Do you have an opinion, Hans? Which way does it go? How do you resolve that tension?
Yeah, and I think I'm a bit surprised, but I actually agree with what was said before, that the real catalyst for change would be more settlement, on-chain settlement. And I think to enable more on-chain settlement, I think we need more regulation to make it happen. And look, so I'm surprised that you said that. Yeah, because
the technologists.
And actually someone else earlier this morning also kind of advocated some form of regulation in the context of KYC and so on, when we talked about identity. And it's my third year that I have the privilege to be on a panel in this conference. And I remember 3 years ago, I felt really that I was making very provocative remarks and talking in favor of regulation. I said, oh my God, can I get out of this room alive by advocating that regulation has some purpose? But I really see there's a bit of a convergence, and I fully agree. I think with some form of regulation enabling easier settlement use, I think that would actually get...
What's going to happen is that, Lucas will be wearing a suit with a tie, and you go right into like the full hoodie and everything. That's what's going to happen.
I mean, I can say one thing about regulation, right? I think good regulation is good. Bad regulation is worse than no regulation. And I would say, I don't know if I will regret saying this, but ever at some point. But I do hope that we will learn something in modernizing AML and KYC regulation, because sending a PDF of a bank statement is really not a way to really make anyone believe that someone who is nefarious actually has a residence at that place. Yet it is what is accepted and what everyone is doing, right? And I think this is where I don't think most people in crypto are not trying to build software to fund terrorism. They build software because they want to build better, more efficient financial software. Now that is mostly, if regulation isn't hindering it, but supporting it, that's good. If regulation is hindering it because you do end up having to ask every user using your application a 15-minute questionnaire for no reason, that ultimately does very little at filtering out illicit use, as we see with many, many big banks having an insane amount of fraud despite asking for utility bill statements, right? I think that is the place where I do hope we can do some things right as we're regulating crypto, as opposed to how it's been done in the past.
You heard it first, the crypto rebel, how I learned to love regulation. Jan.
Yeah, just a remark on regulations. Regulation is here now. We shouldn't ask for more regulations anymore, because it's clear what is clearly missing. Not in Europe, Switzerland, Europe, it's clear now. What is clearly missing is the education level of the bank staff. Compliance, legal, and so on, because they didn't study that during university. So they still, several of them tell me, yeah, but we need regulations. No, just read the books, read the laws. But there's no practice. So what I'm advocating more for is not more regulation, but more practice. So banks should run POCs. They should have teams who are putting their head around how that involves their business, their parts, how they can enable it, and then they will see, oh, it's possible.
Right. And on the topic of regulation, before you close it out, I just want to say,
I think the regulations become the sexiest topic here, but okay, carry on.
Well,
I want to move to something else. Come on, Mathew.
It's quite important. I'll just say that ignorance is the enemy of knowledge, and we absolutely need regulation in the industry. We just need intelligent regulation, and those old, wearisome, ignorant regulators that we currently have need to either adopt or step out of the way.
Okay. Democracy
clear-
needs
it's
to
very
work
clear
then,
that
right? We need democracy.
deal a lot with the US and you deal a lot.
There you go. Fix it all. Yeah, and there's nothing wrong with our political systems. Okay, so let's just shift gears a little bit here because we've only got 7 minutes left, and I, we've gone through this sort of discussion about the back end and how the merging of the TradFi world. And let's imagine we resolve this. That in fact we do get smart regulation. We get the scalability that you're looking for. Custody solutions are solved, and the user experience is something that everyone's on. Let's put our imaginary hats on, a blue sky. What are some of the cool things that could come out of this, right? I mean, the driver of this is it's not just sort of making settlement faster. People talk about the democratization of finance that can come here. What is exciting you guys in terms of the future for, say, tokenization or for just crypto assets?
I would say that it's highly unknown, and it's similar to the internet, where what we can do on the internet today is not possible in the real world. And I believe that what we'll be able to do with tokenized assets in the future, we can't do with real world assets today. So I'm optimistic and excited about the unknown possibilities today.
Notwithstanding Matthew's point that the future is always unknowable, I'm going to get you, Lucas, to look into it. What do you mean? Is it tokenizing real estate? Is it tokenizing fine art? Or what's
Everything.
Yeah, what do you?
It's everything. We're going to see an explosion of opportunities of investable assets, not like nowadays where you need to have a bank account and then you can invest in equities, bonds, funds, maybe some derivatives if you're a sophisticated investor. But you're going to have a wallet where you have all your assets collateral booked into your wallet, and you can see it, and then you have different service providers who will enrich this data for you, will do consolidation, will do reports, will do analysis. And from the bank side, a banking perspective, it will enable us to become much more efficient. So instead of having every bank has its own operations for the settlement, you're going to have it decentralized with exchanges, with atomic swaps and so on, which makes it instant, right? The whole world became instant. Nowadays I can access everything almost besides banking services. There it takes me 2 days to settle a trade. Hopefully soon, one day in the future, it's going to be instant. And not only those bankable assets, but an explosion of assets.
So it's like an explosion of liquidity almost, right, as well, because just the velocity of everything is going to speed up, right?
Very important. I have to say it again and again and again. Just because something becomes tokenized doesn't mean it becomes liquid.
This is where I would say I agree in theory, yes. Just because we have it tokenized doesn't mean it becomes liquid. But this is the thing that I think is going to be one of the biggest changes in the financial system. It's today you have the absolute top of the market that is actually liquid. You have public equities, which are generally traded digitally. You have pretty much everything else. I mean, you have the commodities exchange, you have a few other asset classes, but you go into public bonds, they're mostly traded OTC. You go into private credit, which is the largest asset class in the world, and now it's like a complete jungle, nothing whatsoever that resembles any kind of sophisticated trading infrastructure. That is the status quo. I think tokenization itself doesn't create liquidity, but what tokenization does is it allows a lot of these private assets that today do not have liquidity to actually be traded more easily, to be understood more easily, to be settled more easily. And that will mean that instead of having to spend hundreds of millions of dollars in making a market for an asset class, building an exchange, right? And kind of doing that for something that has a couple of billion in volume, you can now maybe get to a point where a $500 million asset class, maybe even a $100 million asset class, right, does actually get some liquidity. And you see kind of Uniswap is the counter argument to what you're saying, which is now they skip a lot of the regulation, a lot of the other kind of complexities, but I can go there, put $200 in liquidity in there for a token that I create. Now you cannot go and buy $1,000 obviously, but you can go and buy $5 worth of this token, and that works, right? And I do think actually so this world of private and public assets will come much closer together, and that has massive impacts in terms of democratization, because you don't need to find ways to give Google a lower cost of borrowing. You need to find a way to give the solar farm or the coffee shop or the SME credit fund a way to get actually liquidity, right?
Okay, you took where I wanted this conversation to go.
Exactly.
And now we get to Hans, because I'm going to say, like, your customers, right? Thinking not about all the back office and servicing all the banks and the interbank trade, literally the average Joe or average, I don't know, something about an Italian name. I wasn't lost. But who is there participating in this? What do they get out of it? And how does this change in some respect the way you think about servicing a next generation of customers, these up and coming millennials and Gen Zs and the like?
Well, let me start by saying that I fully agree with what my colleagues on the panel have said. And I think the evidence for the hypothesis that we are discussing, that the democratization and the easier access to capital and the lowering of transaction costs, that leads to more growth and that leads to more wealth and more well-being. We find that evidence already in the traditional world. If we look at we have many friends from the US here today. If you see, one of the reasons why the US economic growth is structurally so much stronger than our growth in Europe for the last 10, 20, 30 years is because the US is a more efficient and a better working capital market environment in the traditional world, I'm talking, compared to Europe. It's easier to access equity, to raise money on the stock exchange, to raise bonds, to raise debts. It's easier, simpler, faster, and more efficient than it is in Europe. Now, that benefit of an easier working of a capital market that we already observe in the US versus fragmentalized Europe, if we can bring that thanks to decentralized finance, thanks to blockchain, thanks to all that we're discussing, we could become even more efficient than the traditional US market would work. I mean, we would, that gap, and I'm saying this now from a European perspective, I'm making a bit of a sidestep and an indirect answer to your question, but I feel bad that we in Europe do not enjoy the same access to capital as entrepreneurs have in the US. And I understand why that is. And I think there's structural, the capital market union is what the EU would call it, and so on, structural deficiencies that we still need to solve in Europe. And I think that leapfrogging that and embracing the opportunities of technology could actually help to address that. And I think if just the differences between two traditional systems already prove so much more growth in the US than in Europe, I think we could do even much more if we were to embrace what technology could offer us to make access to capital easier. So, and I think that's to your question. That's in the end what's in it for an entrepreneur, a business owner who needs to run his shop and wants to fulfill his dreams and needs access to financing for that.
Well, you also opened up a geopolitical conversation there about like cross-Atlantic competition of systems, but it's a whole other tangent that we could go down. But we're actually out of time for the main part of the panel, but I think I've got time for one or two questions. Are there any questions anybody has? I can see a hand up there in the back. Yep.
Thank you. Oh, thank you for the conference. This question is mostly for Lucas and Hans on the settlement failure rates. And from what I understand, maybe the solution would be to move away from the Eurodollar system that we're currently in, because that is the reason why there are these settlement failure rates, because of the rehypothecation of U.S. claims. And so maybe the option is a monetary reform instead of trying to fix a unsolvable problem.
It's an interesting perspective.
Also interesting to have GSM interfering in the background of the sound. Any more questions?
Yeah, I'm an optimistic person, so I find it hard to accept that we would not be able to reduce settlement failure rates, and I actually believe that that we can actually continue to make the traditional currency-based settlement systems also more efficient. So I don't think per se that we need a monetary reform to achieve that, but I think if we let settlement occur more prominently using chain-based currencies, I think in the end it will be a survival of the fittest, and then we will organically transition to the most efficient settlement process without having to radically reform.
Very quickly, Plug you. One more question? Anyone? Yes, up front. Yep.
Okay, I have a small question. It's not very, it's a little bit provocative, but this morning we heard about know your customer. We heard about know your X. Now we're hearing about settlements. We heard about compliance. And well, of course I work also in Bill, and I don't know how much time I spend in trying to understand all the time the banking transactions and money inflow and money outflow. But this takes so much time for us working in the bank, for compliance, to make sure that everything is fine. Lucas, you just explained that compliance is just to see if the utility bill is in order, but don't worry, that's not the issue. The issue is the money coming in and coming out. Hearing a little bit what we're hearing today, it's a question for all of you. How can we improve actually the efficiency in making sure that when the money comes into a bank, everything goes much faster, and from a compliance point of view, we are much more comfortable? And is blockchain or is transactional payments that can go through the system where we could actually identify the person that is sending the money, and we feel comfortable with the person sending the money? I mean, he's KYX, KYC, and KYT, which then that's the transaction. This is all settled, and this is fine. This will make business much more efficient for everyone. I don't know if one of you guys can answer this.
Yes.
This one, because we were a lot of times, so yeah.
Very easy. Just use blockchain. Concrete example. When we get fiat in, it's much harder to figure out the source of funds, right? Because we only see I came from Bill, but not where it was before. How long was it at Bill, and so on. If you send me Bitcoin, I see, oh, those were the 100 Bitcoins you bought from us a year ago. You had it on your wallet, you send it back. Or we see, it comes from this bank or broker wallet, and then it was before that and that. So the whole transparency on the source of funds is much clearer. So if we move other assets on the blockchain with the same transparency as, for example, Bitcoin, we could do all the assessment automatically. So we use systems when we get funding for the crypto side, funding, when people pay in, we have automatic system which will in green, orange, lighted, and then you don't have to do the manual processing anymore.
Would say that that's another Pandora's box, though, because then we've got a conversation about privacy and everything else. Unfortunately, we definitely don't have time for that, but I think this was a tremendous panel. Thank you to Hans, to Lucas, to Jan, and to Mathew.